Before we begin, a quick but critical disclaimer. I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only. The world of auto insurance is complex and state-specific, and your personal situation is unique. You should always consult with a qualified and licensed professional to discuss your individual needs before making any policy decisions. Okay, with that out of the way, let's get straight to it. Imagine it's a Tuesday afternoon. You're leaving the grocery store, maybe a little distracted, thinking about what to make for dinner. You put your car in reverse, you check your mirrors, but you don't see the silver sedan creeping up behind you. Then you hear it, that sickening low-speed crunch of metal and plastic. Your heart sinks. It's a minor fender bender, nobody's hurt, but it's a hassle. You exchange information with the other driver, and you're not too worried. Why? Because you have insurance. You pay for it every single month. You've got that little card in your glove box that's supposed to be your get-out-of-jail-free card. A week later, you get the phone call. It's not from your friendly agent. It's from a cold, monotone claims adjuster. And the news is bad. The other driver is now claiming a severe neck injury. Their luxury sedan? The repair estimate is over $30,000. And your policy, that great deal you found online, it only covers $25,000 in property damage. The adjuster calmly informs you that you are personally on the hook for the remaining $5,000. And that's before the medical claims even start. Suddenly, that $50 a month you were saving feels like the most expensive mistake of your entire life. That feeling, that pit in your stomach, the mix of panic and regret, is precisely what this video is designed to eliminate from your life forever. Most of us shop for car insurance completely wrong. We treat it like an annoying chore, a bill we have to pay, so we hunt for the lowest possible number, click a few buttons, and hope we never have to think about it again. But here's the brutal truth the insurance industry banks on. They have spent billions of dollars creating a system that is intentionally confusing. It's filled with jargon, complex legal language, and a million different options designed to make you, the customer, feel overwhelmed. And when you're overwhelmed, you make one of two mistakes. You either wildly overpay for coverage you don't need, or far more dangerously, you buy a policy so full of holes it's like bringing a sieve to a water gun fight. It's useless when you actually need it. But that ends today, right now. In this video, I am pulling back the curtain on the 5 most important secrets that insiders know but most drivers never learn. Getting this right isn't just about saving a couple of $100s a year. It's about building a financial fortress around yourself, your family, and your future, protecting it all from one bad moment on the road. By the time you finish watching, you will no longer be a confused customer. You will be an educated consumer, armed with the knowledge to get the best possible coverage at the lowest possible price. We're going to expose the great coverage lie that bankrupts people, the secret discount codes most agents won't volunteer, why your credit score is the silent killer of your insurance rate, the one optional coverage that's an absolute non-negotiable, and finally, the simple script you can use to challenge your rate and potentially lower it in minutes. So let's not waste another second. Let's dive into the single biggest, most financially catastrophic mistake millions of American drivers are making right now. Thing number 1 you must know is this: state minimum liability is a trap. Let me repeat that. Buying the legal minimum insurance required by your state is one of the most dangerous financial gambles you can possibly take. Every state, except for New Hampshire and parts of Virginia, legally requires you to carry liability insurance. This isn't the insurance that fixes your car. This is the insurance that pays for the damage you do to other people and their property. When you see those numbers on your policy like 25/50/25, that's what they're talking about. It's a code. The first number is the maximum amount, in thousands, that your insurance will pay for a single person's bodily injuries in an accident you cause. The second number is the maximum amount they'll pay for all bodily injuries combined in that one accident. And the third number is the maximum they'll pay for all property damage you cause. So a common state minimum, like in California or Pennsylvania, is 15/30/5. That means your insurance will cover up to $15,000 if you injure one person, a max of $30,000 total if you injure a whole family, and a pathetic $5,000 to repair or replace whatever vehicle you hit. Let's be brutally honest for a second. $5,000. What does that cover in today's world? It might cover the repair bill for a 10-year-old Toyota Corolla if you're lucky. What happens if you rear-end a brand new Ford F-150, the most popular vehicle in America? You've just totaled a $50,000 truck with a policy that covers $5,000. Where do you think that other $45,000 comes from? comes from you. And that's just the property damage. The bodily injury part is even more terrifying. $15,000 for one person's injuries? A single ambulance ride and an emergency room visit can easily cost more than that. And that's before we even talk about surgery, physical therapy, or lost wages. If you cause an accident that results in a serious injury, those medical bills can skyrocket into the hundreds of thousands of dollars, or even millions in the blink of an eye. And when your tiny insurance policy is exhausted in the first 5 minutes, the lawyers for the person you hit don't just shrug and walk away. They come after you. They will go after your savings account. They will go after your investments. They can put a lien on your home. They can get a court order to garnish your wages for years, even decades to come. Your entire financial life, everything you've worked for, can be wiped out because you tried to save $10 or $15 a month on your car insurance. This is not an exaggeration. It happens every single day in this country. Buying state minimum coverage is not an insurance policy. It's a lottery ticket for financial ruin. So what's the solution? The absolute bare minimum any responsible adult should even consider carrying is $100/300/100. That's $100,000 for a single person's injuries, $300,000 total for injuries per accident, and $100,000 for property damage. In today's world, with the rising costs of medical care and vehicles, this should be seen as the new floor. This is the level of coverage that provides a meaningful layer of protection between a car accident and your life savings. Now I know what you're thinking. $100,000? $300,000? That must cost a fortune. And that is the biggest misconception out there. The price jump from a dangerously low state minimum policy to a truly protective $100/300/100 policy is often shockingly small. For many drivers, we're talking about an extra $20 to $40 a month. It's the cost of a few lattes or a Netflix subscription. You are buying hundreds of thousands of dollars of financial armor for the price of a weekly pizza. There is no better return on investment for your peace of mind. So the first action you need to take before you do anything else is to pull up your current policy and look at that liability line. If you see numbers like 15, 25, or 50, you need to call your agent or go online today and get a quote to raise them to at least $100/300/100. Don't think of it as spending more money. Think of it as plugging the biggest, most catastrophic hole in your financial boat. Getting this one thing right is the foundation of being properly insured. Okay, so with your liability limit set, your financial fortress is now protected from attacks coming from the outside. But what about what's happening inside the walls? What about protecting your own car and your own body? This is the second giant piece of the puzzle, and frankly, it's where people get confused by the jargon and end up making costly mistakes. We're talking about collision and comprehensive coverage. Let's break this down with a simple analogy. Think of collision coverage as protection for when your car collides with something. Another car, a pole, a guardrail, a fire hydrant, flipping your car over in an icy ditch. If you are the agent of motion, and that motion ends by hitting an object, collision is your guy. Comprehensive, on the other hand, is for almost everything else. It's the life happens coverage. A deer jumps out of the woods and you hit it. A hailstorm makes your hood look like a golf ball. A tree branch cracks your windshield during a windstorm. Your car gets stolen from the airport parking lot. Someone keys your door out of spite. Fire, flood, vandalism, riots. All of that non-collision chaos is covered by comprehensive. A simple way to remember it: collision is for crashing. Comprehensive is for everything else that can wreck your car. Now, here's where millions of people get it wrong: the deductible. Both of these coverages come with a deductible. This is the amount of money you have to pay out of pocket for a repair before the insurance company pays a single dime. A typical deductible is $500 or $1,000. And here's the trade-off that trips everyone up. The higher your deductible, the lower your monthly premium will be. Insurance companies love when you choose a high deductible. It means you're taking on more of the risk yourself, so they reward you with a lower price. And you might see that you can save, say, $25 a month by raising your deductible from $500 to $1,000. That's $300 a year in savings. Sounds great, right? But here is the absolute, non-negotiable golden rule of deductibles. Never ever choose a deductible you cannot comfortably pay in cash today without causing a financial panic. Let me repeat that. If you do not have $1,000 sitting in a savings account that you could withdraw tomorrow without derailing your life, you have absolutely no business having a $1,000 deductible. The $300 a year you save, will feel like the most foolish decision of your life when you're staring at a $4,000 repair bill, and you can't even come up with the first $1,000 to get the work started. Your car will just sit there broken while you scramble to borrow money. Your deductible should be a number that is an inconvenience, not a catastrophe. For many people, that number is $500. For others with more robust emergency funds, $1,000 is perfectly fine and a smart way to save on premiums. Be brutally honest with yourself about what you can afford to pay out of pocket at a moment's notice, and set your deductible to that number, or lower. Don't let a few dollars in monthly savings trick you into taking a risk you can't afford. Now, this brings up a massive question we get all the time. When should I just drop collision and comprehensive altogether? You've got a 10-year-old car, it's got a few dings, it's paid off. Are you just wasting money paying for this coverage? The answer is maybe, and there's a simple formula the pros use to figure it out. It's called the 10% rule. First, you need to know your car's actual cash value, or ACV. This isn't what you paid for it. It's what it's worth in the open market right now. Go to a site like Kelley Blue Book, enter your car's info, make, model, year, mileage, condition, and get a realistic private party sale value. Let's say your trusty 2012 Honda Civic is worth $4,000. Next, look at your insurance policy. Find out exactly how much you are paying per year just for the collision and comprehensive portion. Your liability and other coverages are separate. Let's say that for your Civic, you're paying $500 a year for collision and comp. Now for the math. What is 10% of your car's value? In this case, 10% of $4,000 is $400. The rule of thumb is this. If the annual cost of your physical damage coverage is more than 10% of your car's value, it's time to seriously consider dropping it. Here you're paying $500 a year to protect a $4,000 asset, which is more than the $400 threshold. Why? Because at a certain point, you're better off self-insuring. You take that $500 you would have paid to the insurance company and you put it into your own savings account. After a couple of years, you'll have a nice little fund for repairs. And if the car gets totaled, well, it was only a $4,000 car. The insurance company, after you pay your $500 deductible, would have only given you a check for $3,500 anyway. By dropping the coverage, you're betting that you won't have a major accident, and you're saving that premium money for yourself. But there is a huge flashing neon warning sign on this. This strategy only works if you have enough cash saved up to either repair or completely replace your car if it gets wrecked tomorrow. If that $4,000 Civic is your only way to get to work, and you don't have another $4,000 to buy a replacement, then losing it would be a financial disaster. In that case, paying the $500 a year for the peace of mind that you'll get a check if it's totaled might be the smartest money you ever spend. Okay, so we've protected your finances from others and we've protected your car. What's left? We need to protect you and your passengers. This is where the medical side of your own policy comes in, and it is criminally misunderstood. We're talking about medical payments coverage, often called MedPay, and personal injury protection, or PIP. Think of these as a small bubble of health insurance that is specifically for car accidents. And it's amazing. Why? Because it pays out regardless of who was at fault. If you cause an accident and break your wrist, this coverage kicks in. If someone else hits you, it kicks in immediately to pay your bills while you're waiting for the other person's insurance to sort things out. MedPay is the simpler of the two. It covers you and your passengers for medical and funeral expenses up to a set limit, usually something small like $1, $2, $5, or $10,000. Personal injury protection, or PIP, is required in no-fault states and is more comprehensive. Not only does it cover medical bills, but it can also cover things like lost wages if you can't work after an accident, and even services you might need to hire like childcare while you recover. Now you might be thinking, I have good health insurance. Why would I need this? It seems redundant. That is a dangerous assumption. Let me tell you why adding even just $5,000 in MedPay can be a financial lifesaver. Your health insurance has a deductible, right? And for many plans, that deductible is high $3,000, $5,000, even $8,000 a year. If you get into a car wreck and have to go to the emergency room, get some x-rays, and see an orthopedic specialist, you could easily rack up $4,000 in bills. Your health insurance won't pay a penny until you've paid that full deductible out of your own pocket. But if you have $5,000 in MedPay on your auto policy, that MedPay money kicks in first. It pays the hospital, it pays the doctor, it pays the physical therapist. It pays that entire $4,000 bill for you. Essentially, your MedPay coverage acts as insurance for your health insurance deductible. You pay a tiny amount on your car insurance premium, often just a few dollars a month, to ensure you never have to pay thousands out of pocket for medical care after a crash. It is, without a doubt, one of the best bargains in the entire world of insurance. So now you've built the fortress. You have high liability limits to protect you from the outside world. You have collision and comprehensive to rebuild your car. And you have MedPay or PIP to take care of your body. You're covered from every angle, right? Almost. There's one more terrifying scenario we haven't accounted for. What happens when the other driver is 100% at fault, but they have no insurance at all, or they only have the pathetic state minimums we talked about earlier? They hit you, they send you to the hospital with $100,000 in medical bills and destroy your brand new car. And they have nothing. Now what? That's one of the most frightening and increasingly common situations you can face on the road. And in the next part, we are going to build an impenetrable shield to protect you and your family from it. That shield isn't made of steel. It's not a bigger, tougher truck. It's a few lines of text on your insurance policy that most people either ignore or don't understand. And it's arguably the most important coverage you can buy. We're talking about uninsured and underinsured motorist coverage. Let's call it UM and UIM for short. This is the coverage that steps in and acts like the other driver's insurance when they have none, or not enough. It essentially puts on a costume, pretends to be the insurance policy of the person who hit you, and pays you for your injuries and damages. It is your personal financial bodyguard, standing between you and the reckless, irresponsible, or just plain unlucky driver who can't make you whole again. And don't think this is a rare one-in-a-million scenario. According to the most recent data from the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. Think about that during your next commute. Look at the 8 cars around you at a stoplight. Statistically, 1 of them has no insurance. If they slam into you, their "I'm sorry" isn't going to pay your mortgage or your kids' medical bills. In some states like Mississippi, it's nearly 1 in 3 drivers. In Florida and New Mexico, it's 1 in 5. This isn't a fringe problem, it's an epidemic. And that doesn't even count the underinsured drivers. These are the people who bought the absolute legal minimum coverage required by their state just to get their license plates. In some states, that minimum liability for injuring someone can be as low as $15,000. $15,000. A single night in the hospital or a few hours in an operating room can blow past that number before you even wake up from the anesthesia. If someone with a bare minimum policy causes an accident that results in $100,000 of medical bills for you, their insurance will write a check for $15,000, wish you the best of luck, and walk away. You are then left on your own to figure out how to pay the remaining $85,000. This is what we call being financially ruined by someone else's mistake. This is why UM and UIM coverage is not a luxury. It's a necessity. It's you insuring yourself against the irresponsibility of others. Let's break down the 2 parts of this shield. First, and most importantly, is uninsured/underinsured motorist bodily injury, or UMBI. This is the heavyweight champion of your policy. This coverage pays for your medical expenses, your passengers' medical expenses, and even the medical bills for family members who live with you if they're hit as a pedestrian. But it goes so much deeper than just hospital bills. It also covers lost wages. Imagine you're a skilled tradesman, a plumber, an electrician, a carpenter. You work with your hands. Someone runs a red light and smashes into your truck, breaking your arm and your leg. You can't work for 6 months. Your health insurance might cover the surgery, but who's going to pay your salary for those 6 months? Who's going to cover the mortgage, the car payment, the groceries? The guy who hit you has no insurance and works an under-the-table cash job. You can sue him, sure, but you can't get blood from a stone. A judgment against him is just a piece of paper if he has no assets. This is where UMBI becomes your savior. It steps in and pays for those lost wages, keeping your family afloat while you recover. It can also compensate you for long-term pain and suffering, permanent disfigurement, or disability. It protects your quality of life and your entire financial future. The second part of the shield is uninsured motorist property damage, or UMPD. This is the part that helps fix or replace your car if it's damaged by an uninsured driver. Now you might be thinking, wait, don't I have collision coverage for that? And you're right, collision coverage also pays to repair your car regardless of who is at fault. So why have UMPD? There are 2 key reasons. First, some people choose not to carry collision coverage, especially on older, paid-off cars. For them, UMPD is the only protection they have if an uninsured driver totals their vehicle. Second, and this is a big one, is the deductible. Your collision deductible might be $500 or $1,000. In many states, the UMPD deductible is significantly lower, often around $250. So if an uninsured driver hits you, you can use your UMPD coverage and pay a much smaller deductible to get your car fixed. It saves you money when it wasn't even your fault. It's important to note that the rules for how UMPD and collision interact vary by state, but in any scenario, having the coverage gives you more options and better protection. So, how much of this coverage do you need? This is where people make a catastrophic mistake. They look at their policy and see they have liability limits of say 100/300/50. That means they're covered for up to $100,000 for injuries to one person, $300,000 total for injuries to everyone in an accident they cause, and $50,000 for property damage. They feel protected. Then they look at their uninsured motorist coverage and see it set at the state minimum, something like $25.50. Do you see the terrifying disconnect here? You have decided that if you cause an accident, someone might need up to $100,000 to recover. But you have also decided that if someone else causes an accident and injures you, you'll only need $25,000. It makes no sense. You are valuing your own health, your own ability to earn an income, at a fraction of a stranger's. You should, at a minimum, match your uninsured motorist bodily injury limits to your own liability limits. If you think you're capable of causing $100,000 in damage to someone else, you must assume someone else is capable of doing the same to you. Protect yourself as well as you protect others. Now, I'm going to share a strategy that your insurance agent might not have told you about. It's a way to supercharge your protection, and it's called stacking. If you have more than one car on your policy, many states allow you to stack your uninsured motorist coverage. Here's how it works. Let's say you have two cars, and you have UMBI limits of $100,000 per person and $300,000 per accident, what we call 100/300. If you have stacked coverage, and you get hit by an uninsured driver, you don't just have 100 to 300 in coverage. You get to multiply those limits by the number of cars on your policy. So with two cars, your coverage instantly becomes $200,000 per person and $600,000 per accident. With three cars, it becomes $300,000 per person and $900,000 per accident. The cost to add stacking is usually incredibly small, yet it dramatically increases the shield protecting your family. It is one of the single best bargains in the entire world of insurance. Some states don't allow it, and some companies have different rules, but you absolutely must ask your agent. Is my uninsured motorist coverage stacked? If it's not, and it's available, add it immediately. This isn't about being paranoid. It's about being realistic. You can be the safest driver in the world, obey every law, and still have your life turned upside down in an instant by someone who has nothing to lose. Your standard insurance protects you from your own mistakes. Uninsured and underinsured motorist coverage protects you from the mistakes of the 1 in 8 drivers who have no way to pay for the damage they cause. It's the difference between a devastating accident being a medical inconvenience or a trigger for bankruptcy. It's the impenetrable shield we've been talking about. So right now, I want you to pull up your policy on your phone or find that piece of paper. Look for the words uninsured motorist and underinsured motorist. Look at the numbers next to them. Are they as high as your liability limits? Are you protected or are you exposed? Because this shield, this UM/UIM coverage, works as a team with another critical piece of your policy. It's a type of coverage that kicks in immediately after an accident, regardless of who is at fault, to pay for medical bills right away. It's the first responder of your insurance policy, and in the next part, we're going to uncover why it might be the key to avoiding financial disaster in the first 72 hours after a crash. Imagine the scene. The screech of tires, the sickening crunch of metal, the sudden violent jolt. In the moments after a car crash, your world shrinks. There's confusion, adrenaline, and fear. Your first thought isn't about insurance claims or legal liability. It's, am I okay? Is everyone else okay? You're dealing with the immediate, visceral reality of the situation. But the clock has started ticking on a different kind of crisis, a financial one. And those first 72 hours are the most treacherous. This is where the real battle begins, long before fault is ever determined. Let's say an ambulance is called. You're taken to the emergency room for evaluation. You have whiplash, maybe some cuts and bruises or worse. You get x-rays, see a doctor, and are sent home with a prescription and an order to rest. You're shaken, sore, but relieved it wasn't more serious. Then, 2 days later, the first envelope arrives. It's a bill from the hospital's emergency department for $2,000. The next day, another one comes. $500 for the ambulance ride. Another for the radiologist who read your X-ray. The numbers start piling up with terrifying speed. Your first instinct might be, well, the other driver ran the red light. Their insurance should pay for this. And you are absolutely right. They should. But should is a word that carries no weight in the world of claims adjusters and investigations. The other person's insurance company isn't going to just take your word for it. They have a duty to their shareholders and their client to investigate the claim. They'll want to see the police report, which can take days or even weeks to become available. They'll want to interview their driver. They'll want to speak with any witnesses. They might even want to inspect the vehicles and analyze the traffic light sequencing. This process isn't measured in hours. It's measured in weeks and sometimes months. While they are investigating, those medical bills are sitting on your kitchen table. They have due dates. And soon they'll be followed by letters that are a little less friendly, and then calls from collection agencies. On top of the physical pain and emotional trauma of the accident, you're now facing a mountain of financial stress. And here's the brutal truth. The hospital, the ambulance company, the doctor, they don't care who was at fault. They provided a service to you, so they are billing you. This is the gap. The terrifying, financially ruinous gap between the moment you incur medical expenses and the moment someone else's insurance company finally cuts a check. This is where lives get derailed, where people drain their savings, max out their credit cards, or worse, avoid getting the follow-up care they desperately need because they can't afford it. Now let's rewind that scenario. Same crash, same injuries, same bills. But this time you have personal injury protection or PIP on your policy, or its cousin, medical payments coverage, often called MedPay. The bills arrive. The panic starts to set in. But then you remember. You make one phone call to your own insurance company. You say, I was in an accident and I have medical bills. You provide the details. And that's it. There's no argument. There's no investigation into who was at fault. Because with PIP and MedPay it doesn't matter. It is no-fault coverage. Your insurance company starts paying those bills directly, immediately. The hospital bill, paid. The ambulance ride, paid. The follow-up visit with a specialist, paid. Suddenly the pressure is gone. The threatening letters stop. The collection calls never start. The financial crisis that was brewing on your kitchen table is completely defused. You are now free to focus on the one thing that actually matters, your recovery. This isn't just a convenience. It's a financial lifeline. Think about it. What if you can't work because of your injuries? If you have PIP coverage, it doesn't just stop at medical bills. In many states, PIP also covers a percentage of your lost wages. If you're out of work for 2 weeks on doctor's orders, that lost income could be devastating. Could mean the difference between paying your rent and facing eviction. PIP steps in and replaces a portion of that paycheck, keeping your household afloat while you heal. It can even cover things like hiring someone to help with household chores if your injuries prevent you from doing them yourself. At this point, you might be thinking, wait a minute, I have great health insurance. Why wouldn't I just use that? It's a fair question, but the answer reveals why PIP and MedPay are so uniquely powerful. First, your health insurance almost certainly has a deductible. It could be $500, $1,000, or even $5,000 or $10,000. That's money you have to pay out of pocket before your coverage even kicks in. PIP and MedPay often have very low or even $0 deductibles. Second, your health insurance has co-pays and co-insurance. You might be responsible for 20% of the total bill, even after your deductible is met. When you're talking about thousands of dollars in emergency room fees, that 20% can still be a crippling amount of money. PIP and MedPay are designed to cover 100% of your costs, up to your policy limit. And third, and this is the absolute game changer, your health insurance will never ever pay you for your lost wages. It covers medical services, period. It won't help you pay your mortgage when you can't work. PIP will. There's one more crucial element. What if you had passengers in your car? Your best friend, your kids, your parents. If they are injured, your health insurance does absolutely nothing for them. They're on their own. But your PIP or MedPay coverage extends to every single person in your vehicle at the time of the crash. It pays for their ambulance rides, their emergency room visits, their follow-up care. You become the person who had the foresight to protect not just yourself but the people you care about. You avoid the nightmare scenario of your friend getting stuck with thousands in medical debt just because they accepted a ride from you. Now the specifics vary by state. About a dozen states, known as no-fault states, actually require you to carry PIP. In these states, your own PIP coverage is your primary source for medical payments after an accident, regardless of who is at fault. This is designed to speed up the payment process and reduce lawsuits. In other states, PIP or the more basic MedPay are optional coverages you can add to your policy, and they are often surprisingly inexpensive for the incredible peace of mind they provide. MedPay typically only covers medical and funeral expenses, while PIP is the more robust version that adds benefits like lost wages and essential services. So when you're looking at that quote and you see a line for personal injury protection or medical payments, don't see it as an extra cost. See it for what it is, a shield. It's a shield against the chaos and delay of the insurance claim system. It's a buffer that protects your savings, your credit score, and your sanity. It's the mechanism that allows the first 72 hours after a crash to be about physical healing, not financial panic. It ensures that the most stressful part of an accident is the accident itself, not the months of financial fallout that can follow. We've now covered how to protect yourself and your passengers from immediate medical costs. We've secured our own oxygen mask first. But this is only half of the equation. What happens when the accident is your fault? What happens when you're the one responsible for the other driver's injuries, for their medical bills, for the damage to their car? This is where the numbers get truly astronomical, and where having the wrong coverage can lead to absolute financial ruin. And that's precisely what we're breaking down next. So let's talk about that ruin. Let's put a face to it. Imagine a guy named Mark. Mark is a responsible driver, a good guy. He pays his bills on time, and he's always had car insurance just like the law requires. He went online, found the cheapest possible option that was legally compliant in his state, and bought it. He saw the numbers on his policy, let's say 25/50/25, a common state minimum, and thought, great, I'm covered. He didn't really know what those numbers meant, but it was the cheapest and it was legal. He felt smart. One rainy Tuesday afternoon, Mark is driving home from work. He's a little tired. He looks down for just a second to change the radio station. In that 1 second, traffic ahead of him slams on the brakes. He looks up too late. He swerves, but he clips the back of a brand new SUV, sending it spinning into another lane where it collides with a minivan. Suddenly, Mark is in a 3-car accident, and he is 100% at fault. The driver of the SUV has a broken arm and a concussion. One of the passengers in the minivan, a mother, has a serious back injury. The other car, the minivan, is totaled. The brand new SUV needs $20,000 in repairs. Medical helicopters are called. The scene is chaos. Mark is fine physically, but financially his life is over. He just doesn't know it yet. This is not a scare tactic. This is the reality of what happens every single day on American roads. And it all comes down to understanding those 3 little numbers on your policy. This brings us to the third critical thing you absolutely must understand when shopping for auto insurance. State minimum liability is a financial trap designed to make you feel safe while leaving you catastrophically exposed. Let's break down what those numbers, like Mark's 25/50/25, actually mean. This is the most important part of your entire policy. It's not just jargon. It's the exact amount of money your insurance company will pay to other people when you cause an accident. The first number, the 25 in our example, stands for $25,000. This is the maximum amount your insurance will pay for any single person's bodily injuries in an accident you cause. That means medical bills, lost wages, pain and suffering for one person. The second number, the 50, stands for $50,000. This is the maximum total amount your insurance will pay for all bodily injuries combined in a single accident. It doesn't matter if you injure 2 people or 10 people. Once the total medical bills hit $50,000, your insurance company closes the checkbook. They are done. The third number, the final 25, stands for $25,000. This is the maximum amount your insurance will pay for all property damage you cause in an accident. This is for the other person's car, or if you hit a fence, a light pole, or God forbid, someone's house. So Mark's cheap, legal policy gives him $25,000 for one person's injuries, a total of $50,000 for everyone's injuries, and $25,000 to fix or replace everything he damaged. Now let's go back to that rainy Tuesday. The driver of the SUV with the broken arm and concussion, her initial emergency room visit, the ambulance ride, the x-rays, and the specialist follow-ups easily cost over $30,000. Mark's policy only covers $25,000, so right away there is a $5,000 gap. But what about the mother in the minivan with the serious back injury? She needs surgery. She'll be out of work for 6 months. Her medical bills alone soar past $100,000. Mark's policy has a $50,000 cap for everyone combined. His insurance company will pay out that $50,000, but that still leaves the SUV driver's remaining bills and almost all of the minivan driver's bills completely unpaid. We're talking about a shortfall of well over $80,000, and that's a conservative estimate. And the cars? The minivan is totaled. It was a few years old, worth about $18,000. The brand new SUV needs $20,000 in repairs. That's a total of $38,000 in property damage. Mark's policy only covers $25,000, another $13,000 gap. So, after Mark's coverage is used up, he is personally on the hook for $5,000 to the first driver, over $80,000 to the second driver, and $13,000 for the cars. In the blink of an eye, Mark, our responsible bill-paying guy, is now personally facing a debt of nearly $100,000. And what happens now? This is the part they don't show you in the cute commercials. The other drivers' insurance companies will pay for their clients' damages initially, but then their lawyers will turn around and come after Mark for every single penny. It's called subrogation. They will sue him, and they will win because the accident was his fault. The court will issue a judgment against him. This means they can garnish his wages, taking money directly from his paycheck every single week until the debt is paid. They can put a lien on his house, meaning he can't sell it or refinance it without paying them first. They can seize his assets, empty his savings account, take his tax refunds, go after non-essential property. His financial life, the future he was building, is now owned by a debt he incurred in a single second of distraction, all because he chose the legal minimum to save a few dollars a month. The state minimum isn't designed to protect you. It's designed to protect other people from you, but only up to a ridiculously low limit that hasn't kept pace with the cost of modern medicine and vehicles for decades. The average cost of a new car in the United States is now over $48,000. Many state minimum property damage limits are just $10,000, $15,000, or $25,000. You could total a single, average American car and immediately exceed your policy limits. You don't need a multi-car pileup. A simple fender bender with a new truck or a Tesla could be enough to put you in financial peril. So what is the solution? Simpler and cheaper than you think. You need to buy more liability coverage. A lot more. Instead of the state minimum 25/50/25, you should be looking at a policy that is, at the very least, 100/300/100. Let's translate that. $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This is a baseline for responsible financial protection in today's world. If you have a home or significant savings, you should be looking at even more, like $250/500/100. Now I know what you're thinking. That sounds expensive. I can't afford that. And that is the single biggest misconception about auto insurance. The relationship between your premium and your coverage limit is not linear. Doubling your coverage does not double your price. Tripling it doesn't triple the price. The jump from a state minimum policy to a truly protective 100/300/100 policy might only cost you an extra $15, $20, or $30 a month. Maybe the price of a few fancy coffees or a streaming subscription. That's because the risk of small claims is high. So the first layer of coverage is the most expensive. The risk of a catastrophic six-figure claim is much lower, so buying that extra protection is exponentially cheaper. You are paying a tiny bit more for a gigantic increase in peace of mind. For the cost of a weekly pizza, you can protect your entire financial future, your house, your savings, your ability to provide for your family. When you frame it that way, choosing the state minimum isn't saving money. It's one of the riskiest financial gambles a person can possibly make. You're betting your entire net worth that you will never, ever make one small mistake behind the wheel. So when you get quotes, do not just accept the default liability limits. Ask them to quote you at 100/300/100 and then at 250/500/100. Look at the difference in the monthly premium. You will be shocked at how affordable true protection actually is. This is the foundation. This is what separates a piece of paper that makes you legal from a real financial shield that actually protects you and your family. But for some of us, even this might not be enough. What if you're a homeowner or have a healthy retirement account? What if you cause an accident where the damages exceed even these higher limits? There's another layer of protection, a secret weapon in the insurance world that is shockingly inexpensive and can protect you into the millions. It's called an umbrella policy. And the name is perfect because that's exactly what it does. Think of your auto insurance and your homeowner's insurance as your regular rain jacket and boots. They protect you from the everyday showers, the common risks. But an umbrella policy? That's your giant, reinforced stormproof umbrella that you pull out during a hurricane. It sits on top of your other policies, and when a catastrophic event happens, a financial hurricane, and your primary policies are exhausted, the umbrella opens up and shields you from the deluge. It's not your first line of defense. It's your last and most powerful line of defense. Let's stop talking in analogies and use a real-world, gut-wrenching example. Picture this. You're driving home from work on the freeway. It's been a long day. You're following a respectable distance behind a minivan. Your phone in the center console buzzes with a notification. For one single second you glance down. In that 1 second, the minivan in front of you slams on its brakes. You look up, but it's too late. You swerve instinctively, clipping the minivan and careen into the next lane, right into the path of a new Mercedes sedan. The impact is violent. The Mercedes is sent spinning into a third car, a contractor's van. It's a chain reaction, a mess of twisted metal, shattered glass, and screeching tires. When the dust settles, the scene is grim. The minivan has severe rear-end damage. The expensive Mercedes is completely totaled. The contractor's van is also a write-off, and all his expensive tools and equipment inside are destroyed. But that's just the property damage. The real nightmare is the human cost. The driver of the Mercedes, a successful surgeon, has a severe back injury and a broken wrist on his dominant hand. He'll need multiple surgeries and extensive physical therapy. He won't be able to perform surgery for at least a year, maybe longer. His career, his primary source of income, is in jeopardy. In the minivan, a mother and her 2 children have concussions and whiplash. The contractor in the van has a broken leg. The lawsuits begin. The surgeon sues you for his medical bills, which are astronomical. He also sues for his lost income, and a surgeon's income is substantial. We're talking hundreds of thousands, if not millions of dollars over the course of his recovery. The mother in the minivan sues for her medical bills and those of her children, plus pain and suffering. The contractor sues for his medical bills, his lost wages while he can't work, and the total value of his destroyed van and all the tools of his trade. Let's add it up. Let's be conservative. The property damage alone. The totaled Mercedes, say $70,000. The totaled contractor van, another $40,000. His tools, $20,000. The minivan repair, $10,000. That's $140,000 in property damage right there. Now for the bodily injury. The surgeon's initial medical bills are $200,000. His lost income for the first year is $500,000. The family in the minivan racks up $50,000 in medical bills. The contractor, another $40,000. The total bill for this 1-second glance at your phone is now over $900,000. And that's before the lawyers start tacking on pain and suffering, future medical costs, and diminished earning capacity for the surgeon, which could push the final judgment well over $1.5 million. Now let's look at your good auto insurance policy. You were responsible and got the 250/500/100 limits we talked about. Your policy will pay a maximum of $100,000 for all that property damage. You're already $40,000 in the hole there. For the bodily injuries, your policy will pay a maximum of $250,000 per person, with a total cap of $500,000 for the entire accident. The surgeon's claim alone is more than that. The total injury claims are approaching $1 million. Your policy pays out its max. $100,000 for the property, $500,000 for the injuries. Total payout, $600,000. The total judgment against you was $1.5 million. Your insurance paid $600,000. You are personally on the hook for the remaining $900,000. Let that number sink in. $900,000. What happens now? The lawyers for the victims will come after you. They will put a lien on your house. They will go after your savings account, your investment portfolio, your kids' college funds. They will garnish your wages for decades, taking a chunk out of every single paycheck you earn until that debt is paid. Your financial life, everything you have worked for, everything you hope to build for your family, is utterly and completely destroyed. All because of 1 second of distraction. Now let's rewind. Same horrific accident. Same $1.5 million judgment. But in this version of the story a year ago, you paid about $200 for a $1 million umbrella policy. Here's what happens instead. The claims come in. Your auto insurance company evaluates them and pays out its maximum limits, the full $600,000. Then that giant stormproof umbrella opens. Your umbrella policy kicks in seamlessly and covers the rest. The remaining $900,000? The umbrella policy pays it. The lawyers, the negotiations, the settlement, the insurance company handles it all. Your house is safe. Your retirement account is safe. Your future paychecks are safe. Your entire financial world, which was on the brink of collapse, is kept whole. For the price of a few cups of coffee a month, you just averted complete and total financial ruin. That is the power of an umbrella policy. And its protection extends far beyond your car. This is what makes it such an incredible value. Let's say your dog gets out and bites the neighbor's kid, leading to plastic surgery and a lawsuit. Your homeowner's insurance might cover the first $300,000, but the judgment is for $700,000. The umbrella covers the difference. What if you host a summer barbecue? A guest slips on a wet spot by the pool and suffers a debilitating injury. Umbrella is there. What if your teenager, trying to be edgy online, posts something libelous about a teacher that ruins their reputation, and you get sued for defamation? Many umbrella policies cover that too. It covers you anywhere in the world. If you're on vacation in Italy, rent a boat, and cause an accident, your umbrella policy can protect you. It is a blanket of liability protection over your entire life. And now for the most shocking part, the part that makes it a complete no-brainer. The cost. For a $1 million layer of protection on top of everything you own, the typical cost is between $150 and $300 for the entire year. That's it. It's often less than $1 a day. You can easily spend more on streaming services in a year than you would on a policy that can literally save you from bankruptcy. The reason it's so cheap is that the insurance company knows the chances of $1 million claim are rare. But rare is not the same as never. And if you are that one rare case, the low cost is the single greatest return on investment you will ever see in your life. There's a huge misconception that umbrella policies are only for the rich. It's the exact opposite. Wealthy people might have the assets to absorb $1 million lawsuit. But for a middle-class family, a family with $100,000 of equity in their home, $200,000 in a 401k, a steady income, you are the prime target. You have enough assets to be worth suing, but not enough to survive the lawsuit. You are in the crosshairs. You have the most to lose. To get one, there are a couple of requirements. The insurance company will want you to have your underlying policies like auto and home with them, and they'll require you to carry those higher liability limits we discussed earlier, typically that $250/500/100 on your auto, and at least $300,000 on your home. They want to make sure your rain jacket is solid before they sell you the hurricane-proof umbrella. So we've now protected you from being sued into oblivion. Your assets are secure. Your future wages are safe from garnishment. But all of this has been about protecting you from the damage you caused to other people. We haven't even begun to talk about the single most expensive asset most of us are driving around every day, our own car. What happens when your $20,000, $30,000, or $50,000 vehicle is damaged or destroyed? That's a totally different part of your policy, and it's where people make the single costliest mistake when it comes to their deductible. This brings us to the two coverages that protect your actual vehicle: collision and comprehensive. And they are not the same thing. People mix them up constantly, but the difference is simple. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, a fire hydrant, or even if you just roll your car. If you collide with something, collision is what kicks in. Comprehensive coverage is for almost everything else. Think of it as other than collision. This is the coverage that protects you from things largely out of your control. Your car gets stolen? That's comprehensive. A hailstorm turns your hood into a golf ball? Comprehensive. You're driving down a country road at dusk, and a deer decides to redesign your front end? Comprehensive. A tree branch falls on it during a storm, it catches fire, it's damaged in a flood, or someone vandalizes it. All comprehensive. Now, for both of these coverages, you have to choose a deductible. And this is it. This is the moment where the costliest mistake is made. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. So, if you have a $500 deductible and you have a $3,000 repair bill, you pay the first $500, and the insurance company pays the remaining $2,500. Simple enough. The mistake happens when people are trying to lower their monthly premium. The insurance quote system will show you, clear as day, that if you raise your deductible from $500 to $1,000, your premium will go down. Maybe it saves you $10, $15, even $20 a month. And the temptation is powerful. You think, wow, I can save $240 a year just by clicking this button. I'm a safe driver, I probably won't even have an accident. So you click it. You raise your deductible to $1,000, maybe even $1,500 to save a little more. And for a year, 2 years, you feel like a genius. You've saved almost $500. Then it happens. A moment of distraction, a patch of black ice, a deer in the headlights. You get a repair estimate for $4,000. And suddenly your heart sinks. Because before you can get your car back, before the insurance company pays their $3,000, you have to write a check for $1,000. That $240 you saved over the entire year? It's gone, and you still have to find another $760 right now. Money that most people don't just have sitting around for an emergency. This is the trap. A high deductible is only a good financial decision if you have that exact amount of cash, liquid, in an emergency fund, ready to be spent at a moment's notice without causing you financial stress. If you don't, you are essentially gambling that you won't have an accident. You are trading a small, predictable monthly savings for the risk of a massive, unpredictable, and immediate financial blow. For most people, a lower deductible like $250 or $500 is the much safer, smarter bet. The slightly higher premium is you prepaying for peace of mind. Ensuring a minor accident doesn't become a major financial crisis. But what if the damage is really, really bad? What if the car isn't reparable? This is when your insurance company might declare your vehicle a total loss. And this opens up a whole new world of confusion, centered on 3 little words: actual cash value. This is one of the most misunderstood concepts in all of insurance, and it's the source of so much frustration. When your car is totaled, the insurance company does not pay you what you paid for the car. They do not pay you what it costs to go buy a brand new one just like it. They pay you the actual cash value, or ACV, of your car the second before the crash happened. So what is ACV? It's basically the replacement cost of your vehicle minus depreciation. Think of it like this: your car is a 2019 model that you bought for $30,000. It's now 3 years old and has 50,000 miles on it. It's got some wear and tear, the tires are a little worn, maybe a small stain on the back seat. It's a used car. The insurance company's job is to determine what a willing buyer would have paid for your specific 2019 car, with its specific mileage and condition, on the open market, right before the accident. They use valuation guides, they look at comparable sales in your area, and they come up with a number. Let's say that number is $20,000. That is the actual cash value. From that $20,000, they will then subtract your deductible. If you have a $1,000 deductible, you're getting a check for $19,000. And this is where people get angry. They say, $19,000. But I paid $30,000. And a new one is now $35,000. How am I supposed to replace my car with this? And the hard truth is, the insurance policy wasn't designed to put you in a brand new car. It was designed to give you the cash value of the used car you just lost. A car is declared a total loss, not just when it's a twisted heap of metal, but when the cost to repair it safely and properly exceeds a certain percentage of its actual cash value. That percentage, called the total loss threshold, varies by state and by insurance company, but it's often around 75 or 80%. So using our example, your car's ACV is $20,000. The repair estimate comes in at $16,000. Even though the car is technically reparable, the insurance company will look at that and say, nope, the repairs are 80% of the car's value. It's a total loss. They'll write you that check for $19,000, and then they take possession of your wrecked car and sell it to a salvage yard to recoup some of their costs. It's a purely economic decision for them. Now, this ACV problem creates a terrifying financial scenario for millions of Americans who have a car loan. Because cars depreciate fast. The moment you drive a new car off the lot, it can lose 10% of its value. But your loan balance goes down much, much slower. This creates a period of time where you are upside down or underwater on your loan, meaning you owe the bank more than the car is actually worth. Imagine you owe $22,000 on the loan for that car that just got totaled. The insurance company hands you a check for $19,000. You have to immediately turn around and give that entire check to the bank, but you still owe them $3,000. So now you are in the worst possible position. You have no car, and you have to keep making monthly payments on a $3,000 loan for a car that doesn't even exist anymore. It is a financial nightmare. But there is a specific type of coverage designed to prevent this exact scenario. It's called gap insurance. Gap insurance does exactly what the name implies. It covers the gap between the actual cash value of your vehicle and the amount you still owe on your loan or lease. In our example, gap insurance would have paid that extra $3,000 to the bank, clearing your loan completely. It leaves you at zero. You have no car, but you also have no debt. You can start fresh. If you are buying a new car, especially with a small down payment, or rolling old debt into your new loan, or taking out a loan for 60 months or longer, you absolutely must have gap insurance. You can usually buy it from the dealership or, often for much cheaper, add it directly to your auto insurance policy. For those who want even better protection, there's another, more premium option called new car replacement coverage. If you have this on your policy and your brand new car gets totaled within the first year or two of ownership, the exact terms vary, the insurance company will ignore actual cash value. They won't just give you the depreciated value. They will pay to replace it with a brand new car of the same make and model. It costs more, but it completely eliminates the issue of depreciation for the first couple of years, giving you ultimate peace of mind. So we've covered your liability, the damage you do to others, and we've just covered collision and comprehensive, the damage that happens to your own car. We've tackled the deductible trap and the nightmare of actual cash value. You're now armed with the knowledge to protect your biggest assets. But what about all the other costs that pop up after an accident? The hidden expenses that can bleed you dry while your car is in the shop? I'm talking about the tow truck that hauls your car from the scene, the rental car you need to get to work for 2 weeks, the roadside assistance when you get a flat tire in the middle of nowhere. Are these things included? Or are they expensive extras you need to ask for? Getting this wrong can leave you stranded, both literally and financially. This brings us to the fourth critical thing you must understand: mastering the add-ons that truly matter. These are often called riders or endorsements, and it's easy to dismiss them as nickel and dime upsells. The agent might breeze past them saying, "And for just a few dollars more." And your instinct is to say no to keep the price down. But this is a catastrophic mistake. These aren't just features, they are financial life rafts. They are the difference between a minor inconvenience and a life-altering disaster. Let's start with one of the most common and most misunderstood: rental reimbursement. Sounds simple. If your car is in the shop after a covered accident, the insurance company helps pay for a rental car. Easy, right? But the devil is in the details. Most policies have a daily limit and a total limit, something like $30 a day, with a maximum of $900. Now let me ask you, when was the last time you could rent any decent car for $30 a day? Maybe 5-10 years ago? Today, with taxes and fees, you're looking at $50, $60, even $70 a day for a basic sedan. And that $900 maximum? That only covers you for 30 days at that low $30 rate. What happens when the body shop calls and says, "Sorry, the specific sensor we need for your car is on backorder from Germany. It's going to be 6 weeks, maybe 8. This is happening every single day across America due to supply chain issues. Suddenly, your $900 coverage runs out in about 2 weeks. You're still without a car for another month or more. How do you get to work? How do you take your kids to school? You're now paying hundreds, maybe thousands of dollars out of pocket for a rental, or begging for rides, or navigating a public transit system that just doesn't work for your life. All because you tried to save maybe $5 a month on your premium. Think about Sarah, a single mother and a freelance photographer. Her car is her office. It gets her to shoots, it carries her expensive equipment. Someone runs a red light and T-bones her SUV. The car is reparable, but it's going to take a month. Sarah had the foresight to upgrade her rental coverage to $50 a day with a $1,500 max. That small decision, that extra cost of a cup of coffee each month, meant her business never missed a beat. She got a comparable SUV, her equipment fit, she made it to every client meeting, and her income never stopped. Her competitor, who might have skipped that coverage, would have been crippled. For Sarah, it wasn't just rental car coverage. It was business interruption insurance. Next up, roadside assistance. Many people think, "I have a new car, I don't need that." Or, "I'll just call a tow truck if something happens." Let me tell you a story. It's 11 p.m. on a Tuesday. You're driving through a rural part of the state, miles from the next town. Cell service is spotty, and then you hear it. The dreaded thump-thump-thump of a flat tire. You pull over. It's pitch black. Cars are flying by at 70 miles an hour. You don't have a spare or you don't know how to change it. What do? If you have roadside assistance on your policy, you make one call. You open your insurance app, press a button, and your GPS location is sent. They tell you a truck will be there in 25 minutes. Peace of mind. Safety. If you don't have it, you're frantically Googling for a 24-hour tow service in a town you've never heard of. You have no idea if they're reputable. You have no idea what they'll charge. That emergency tow could be $200, $300 cash up front for a service that costs about as much as a pack of gum per month on your insurance policy. It's not just about the money. It's about being in a vulnerable situation and having a trusted, prepaid solution at your fingertips. But now we need to talk about the single most important coverage that people either don't have or don't have enough of. This is the one that can protect you from absolute financial ruin. I'm talking about uninsured and underinsured motorist coverage. Let's call it UM/UM. Let this sink in. The Insurance Research Council estimates that 1 in 8 drivers on the road in the United States has no insurance. That's almost 13% of the cars you see every single day. They are financial time bombs on wheels. Here's how it works. Let's say one of those uninsured drivers blows through a stop sign and plows into you. You're seriously injured. You have a broken leg, a concussion. You need surgery, physical therapy. Your medical bills are quickly approaching $100,000. You can't work for 3 months. Who pays for all of this? The other driver? He has no insurance. You can sue him, sure. But you can't get blood from a stone. If he couldn't afford a $50 a month insurance premium, he certainly doesn't have $100,000 sitting around to pay your medical bills. This is where your uninsured motorist coverage becomes your superhero. It steps in and acts like the at-fault driver's insurance. It pays for your medical bills, your lost wages, your pain and suffering, up to the limits you selected. Without it, you are on your own. Your life is turned upside down by someone else's irresponsibility, and you are left holding the bag. But the even more common, more insidious threat is the underinsured motorist. This is the driver who did the bare minimum. They bought the cheapest policy they could find, with state minimum liability limits. In many states, that might be just $25,000 for bodily injury. Imagine you're on your motorcycle, enjoying a beautiful Sunday afternoon. A car makes a left turn directly in front of you. You have no time to react. The accident is 100% their fault. But the impact is devastating. You're airlifted to a trauma center. You spend weeks in the hospital. You have multiple surgeries. Your medical bills are $300,000. And that's before you even factor in the fact that you'll never be able to work your old construction job again. The driver who hit you has that state minimum $25,000 policy. Their insurance company writes you a check for $25,000. And that's it. That's all they're legally required to pay. You are still short $275,000 in medical bills, not to mention your lost future income. Your life is shattered. But if you had the foresight to buy a high-limit underinsured motorist policy, say for $250,000, your own insurance company would step in and cover the difference. They would pay you that remaining $250,000 to make you whole. It is, without a doubt, the most important coverage you can buy to protect your own body and your own financial future from the mistakes of others. Skimping on liability is irresponsible. Skimping on your own UM/UIM coverage is self-destructive. Finally, there's a related coverage called medical payments or MedPay, and in some states, personal injury protection or PIP. These are designed to pay for your and your passengers' medical expenses right away, regardless of who is at fault in an accident. You might think, I have good health insurance, I don't need that. But your health insurance has deductibles, co-pays, and co-insurance. A single ER visit after an accident could cost you thousands out of pocket before your health plan really kicks in. MedPay can cover that deductible. It can pay for things your health insurance might not, like ambulance rides, dental work, or chiropractic care. It pays quickly without waiting for the fault to be determined, getting you the care you need when you need it. So you've built the perfect policy, a fortress of protection with all the right coverages and add-ons. But now you're looking at the price tag and your heart sinks. Seems impossibly high. But what if I told you there are hidden levers you can pull, secret handshakes you can use to slash that premium by hundreds, even thousands of dollars a year, without sacrificing a single drop of that crucial coverage? The insurance companies have these discounts, but they don't always volunteer to give them to you. You have to ask for them. You have to know they exist. So let's pull back the curtain. Let's learn the secret handshakes. First up are the absolute biggest, the most powerful, the ones that can single-handedly change your entire insurance bill. I call them the loyalty levers. The number one discount, the king of them all, is the multi-policy or bundling discount. This is the slam dunk of insurance savings. If you have renters or homeowners insurance with one company and your auto insurance with another, you are almost certainly lighting a pile of money on fire every single month. Insurance companies are obsessed with what they call stickiness. They want you so deeply embedded in their ecosystem that leaving is a hassle, and they are willing to pay you in the form of a massive discount to make that happen. By bundling your home or renter's policy with your auto policy, you're not just getting a small $10 a year thank you. We're talking discounts that can range from 5% to as high as 25% off your entire premium. Both of them, it's a win-win for the insurer. They get more of your business and you become a much more loyal long-term customer. For you, it's one less bill to manage and hundreds of dollars back in your pocket. Right next to this is the multi-car discount. It's the same principle. If you and your spouse or partner have cars insured with two different companies, you're missing out. Combining them onto one policy almost always triggers a significant discount. Before you do anything else, before you even think about the other stuff we're going to talk about, you need to ask yourself, can I bundle? It is the foundation of all insurance savings. Next, let's talk about the discounts you earn. These are the good behavior discounts. The most common is the safe driver or good driver discount. This is the insurance company's way of rewarding you for not costing them money. If you've gone 3 to 5 years without an at-fault accident or a major moving violation, you should be getting a discount. But here's the secret. The definition of safe driver varies. Some companies are more forgiving of a single speeding ticket. Some have tiered systems where the discount gets bigger the longer you stay clean. Don't just assume you're getting it. When you get a quote, you need to explicitly state your clean record and ask, based on my driving history, what is the maximum safe driver discount I qualify for? Make them say the number. A related perk here is accident forgiveness. It's not a discount, but an earned benefit where the company agrees not to raise your rates after your first at-fault accident. It can be worth its weight in gold. And for the students in your family, or if you're a student yourself, there's the classic good student discount. This is pure statistics. Data shows that students who maintain a B average or better are statistically less likely to get into accidents. They're seen as more responsible. So if you or a driver on your policy is in high school or a full-time college student under the age of 25 and they're hitting the books and getting good grades, that's a discount. You'll need to send in a report card or transcript to prove it, but it can knock a meaningful 10 to 15% off the premium for that driver, which for a young driver is a huge amount of money. Want to be more proactive? Take a defensive driving course. These are certified courses, often available online, that teach you to anticipate hazards and react safely. Once you complete it and send the certificate to your insurer, boom. Instant discount, typically 5 to 10% that lasts for 3 years. The cost of the course is usually less than what you'll save in the very first year. You're literally paying a little to save a lot, all while becoming a safer driver. Now let's move on to your car itself. These are the tech and safety discounts. Your car is packed with features designed to prevent accidents or protect you in one, and each of those features is a potential discount. Anti-lock brakes, airbags, daytime running lights, electronic stability control. Most modern cars have these, but you can't assume your insurance company's database knows that. You have to verify it. But the one they really care about, the one people forget, is the anti-theft system. If your car has a passive alarm that arms itself automatically, or a vehicle recovery system like LoJack, that is a major deterrent to thieves. Since theft is one of the big things you're insured against under your comprehensive coverage, anything that makes your car harder to steal means you're a lower risk. And lower risk means a lower premium. Okay, but what about the biggest, most controversial, and potentially most lucrative discount of them all? This is the one that separates the old way of doing things from the new. It's called usage-based insurance or telematics. This is the prove it discount. You agree to let the insurance company monitor your actual driving habits, usually through a smartphone app or a small device you plug into your car's diagnostic port. It tracks things like how many miles you drive, what time of day you drive, how hard you brake, how fast you accelerate, and whether you're using your phone while driving. It sounds a little Big Brother. And for some people, that's a deal breaker. The privacy trade-off is real, but the upside can be astronomical. If you are a genuinely safe driver who doesn't speed, doesn't slam on the brakes, and doesn't drive late at night, this program can prove it to the insurance company in a way a simple driving record never could. The potential savings aren't just 5 or 10%. We're talking up to 30 or even 40% off your premium in some cases. It turns your insurance from a fixed cost based on demographics to a variable cost based on your actual behavior. It's the ultimate put your money where your mouth is discount. But be warned, the sword can cut both ways. If you sign up and the app reveals you're a risky driver, your rates could actually go up with some companies. You have to be honest with yourself about your driving habits before you plug in. Beyond the high-tech stuff, there are simpler, lifestyle discounts. The low-mileage discount has become huge in the age of remote work. If you drive less than the national average, typically around 7,500 miles a year, you are a much lower risk. You're just not on the road as much. Many people who used to have long commutes are now working from home and their mileage has plummeted, but they never told their insurance company. That's a mistake. A 5-minute phone call to update your estimated annual mileage could save you hundreds. Then there's one of the most underutilized discounts out there, the affinity or occupational discount. Insurance companies love groups. They partner with employers, universities, alumni associations, professional organizations, credit unions, even wholesale clubs like Costco. If you're a teacher, an engineer, a nurse, a first responder, a scientist, or a member of the military, there is very likely a discount waiting for you. If you're a member of AAA, AARP, or your college's alumni group, ask about a discount. This is free money. You've already earned the membership or the job title. You just have to raise your hand and claim the reward that comes with it. Finally, there are the easy money discounts. These are small, but they add up and require almost zero effort. Paying your premium for the full 6 or 12-month term up front instead of in monthly installments will almost always get you a discount. Why? Because it saves the company administrative costs and ensures they get their money. Signing up for automatic payments from your bank account, EFT, does the same. Going paperless and receiving your documents by email? That's another tiny discount. On their own, these are maybe $5 or $10 a month. But add them all together, and it's another $100 or more a year back in your wallet for doing basically nothing. So there you have it. Bundling safe driving, good grades, car features, telematics, low mileage, your job, and how you pay. This is the playbook. This is the list of secret handshakes. You now know more about auto insurance discounts than 95% of the drivers on the road. But knowing these discounts is only half the battle. Because even if you get every single discount you qualify for, you could still be overpaying by a massive amount. Why? Because the single most powerful money-saving tool in your arsenal has nothing to do with any of these. It's a strategy, a mindset that forces companies to compete for your business. And mastering it is the final crucial step to guaranteeing you never ever pay a penny more for insurance than you have to. It's called the loyalty penalty reversal. And it's not a secret code or a hidden discount. It's a fundamental shift in how you view your relationship with your insurance company. For decades, they have spent billions of dollars on advertising to convince you of one simple, powerful, and incredibly profitable idea: that loyalty is a virtue. They've told you that you're in good hands, that they're like a good neighbor, that sticking with them through thick and thin is the smart, safe, and responsible thing to do. But here is the cold, hard truth they will never ever put in a commercial. In the world of insurance, loyalty is not a virtue. It's a liability. It's a vulnerability. And they have systematically weaponized it against you. The industry has a quiet, insidious practice known by many names: price optimization, price elasticity, or more bluntly, the loyalty tax. It's an algorithm-driven strategy that slowly, almost imperceptibly, raises your rates year after year. They're not raising your rates because you became a worse driver. They're not raising them because your car is suddenly more expensive to repair. They are raising your rates for one reason and one reason only: because their data shows you are unlikely to leave. They profile you. They know that customers who have been with them for 5, 7, or 10 years have a high level of inertia. They know you're busy. They know you hate the hassle of shopping around. They know you probably won't even notice an extra $12 on your monthly bill. Or 20. So they push it. Little by little. A 4% increase here, a 6% increase there. It's a death by 1,000 cuts. They are rewarding your loyalty with a penalty. They are taxing your trust. The loyalty penalty reversal is the act of recognizing this game and refusing to play. It's about seizing the power that you, the customer, have always had but were conditioned to forget. The power of choice. The power of the free market. It means transforming yourself from a passive, captive customer into an active, informed shopper. And you don't do it once. You do it systematically. You make it a ritual. Here is the exact step-by-step playbook to execute the loyalty penalty reversal and guarantee you are always paying the most competitive rate. First, you need a trigger. Don't wait until you're angry about a rate hike. Be proactive. Pick a date on the calendar. I recommend doing this every single year, approximately 30 to 45 days before your policy is set to renew. That renewal date is your deadline. The 45-day mark is your starting gun. Put it in your phone's calendar right now. Set a recurring annual reminder. Label it. Save hundreds on car insurance. Make it a non-negotiable appointment with yourself, like a doctor's visit or a performance review. Because that's what this is. A performance review of your insurance company. And if they're not performing, they're getting fired. Second, prepare your arsenal. You don't go into a negotiation unprepared. Create a single, simple folder on your computer desktop. Insurance shopping. Inside this folder, you will have digital copies of 3 key documents. 1. Your current policy's declarations page. This is the holy grail. It lists all your coverages, your limits, your deductibles. This is the benchmark you'll use to compare apples to apples. 2. A document with the driver's license numbers and dates of birth for every driver in your household. 3. A document with the year, make, model, and vehicle identification number, the VIN for every car you need to insure. With this folder, you can get a quote from any company in the country in about 10 minutes. The hassle is now gone. You've streamlined the process. Third, you launch a multi-pronged attack. Your goal is to get a minimum of 5 competing quotes. Never ever just get one. That's like walking into a single car dealership and buying the first car you see without checking the price anywhere else. It's financial malpractice. You need to create a bidding war for your business. And here's how you get the best cross-section of the market. You get one quote from a major direct-to-consumer company, like Progressive. You get another from their biggest rival, like Geico. These are the baseline quotes. Next, you contact an independent insurance agent. These are the agents who don't work for one single company. They represent dozens. They are your market insider. Tell them your current coverages and ask them to shop their network to find the best deal. This is what they do for a living. Let them work for you. That's quote number 3. Then you get a quote from what's called a captive agent. Someone who only sells for one company, like State Farm or Allstate. This covers all your bases. The direct writers, the independent network, and the legacy carriers. You are now looking at the entire landscape. Fourth, and this is the most important step, the leverage play. Let's say you've been with Omni Assurance for 8 years, and your annual premium is $2,000. But after your shopping blitz, you find a quote from a top-rated competitor for the exact same coverage for just $1,400. That's a $600 difference. Your first instinct might be to just switch and celebrate. Don't. Not yet. You pick up the phone. You call the customer service line for Omni Assurance, the one they call the loyalty or retention department. You get a representative on the line and you say the following calmly and politely. Hello, my name is your name, and my policy number is your policy number. I've been a loyal customer with you for 8 years. My policy is up for renewal soon, and as part of my annual financial review, I've been getting some competing quotes. I have a firm offer from competitor's name, which is another A-rated company, for the exact same coverage I have with you now, but for $600 less per year. I genuinely like being a customer here, so I'm calling to see if you can match that rate to keep my business. And then you stop talking. The silence that follows is the sound of power shifting. You have just turned the tables. You've taken their loyalty tax and turned it into a loyalty discount. You have presented them with clear, undeniable data that their price is not competitive. In that moment, you are no longer a passive price taker. You are an active negotiator. Sometimes they will miraculously find discounts you never knew existed. They'll review your policy and the rate will magically drop. Sometimes they'll match it exactly. Other times they'll come close. And sometimes they will hold firm and say there's nothing they can do. And if that happens, you thank them for their time, you hang up and you switch. You win by getting a better rate from your current company, or you win by moving to a new company and saving a fortune. There is no losing scenario. This is the system. A calendar trigger. A prepared arsenal, a multi-pronged quote attack, and the final leverage play. It might take you 2 hours once a year. If you save $600, you have just paid yourself $300 an hour tax-free. Show me another part-time job that pays that well. This is the final piece of the puzzle. It's the engine that makes all the other knowledge work. Understanding your coverage is critical. Knowing which discounts to ask for is essential. Protecting your credit score and being smart about telematics are powerful tools. But none of it matters if you let your insurance company put you on autopilot and charge you the loyalty tax. This process isn't about being cheap. It's about being smart. It's about refusing to subsidize a company's marketing budget with your own hard-earned money. It's about taking back control in one of the most significant financial transactions your family makes every single year. You are the prize. Your premium dollars are what these billion-dollar giants are fighting for. It's time you started acting like it. It's time you made them earn your business, not just this year but every single year. That is how you win the game.